Welcome back, everyone, to another deep dive. So think about your pantry for a second. Chances are you've got a few familiar treats in there, right? Maybe some chocolate, some pretzels.
Oh, yeah, definitely. Hard to avoid them. Maybe a bag of candy that seems to evaporate overnight.
Exactly. But do you ever stop and think about the huge corporate engine behind those snacks?
It's easy just to grab the wrapper, isn't it? But yeah, behind it is this massive snacking powerhouse. Their brands are everywhere.
Totally. And that's our mission today, to kind of pull back the curtain on this giant. We're digging into their latest 2024 annual report, cutting through the jargon and the numbers to find the really important stuff. We want to give you a clear picture of the company's health right now, where they're heading strategically, and what the future might look like.
hmm It's all about understanding a business that wants to be a leading snacking powerhouse. And they're focused on, what is it, four big things: building brands, retail partnerships, efficiency, and tech.
Right, those four strategic imperatives. So with that vision, how are they actually doing it? How are they executing? Let's start with innovation. The report kicks off talking about a strong start to 2025, driven by some pretty exciting new products. Okay, let's unpack this. What are some of the standout new things driving that momentum?
Yeah, they're definitely pushing hard on innovation. It's not just minor tweaks. We're seeing things like the Reese's Caramel and Lava Big Cups, familiar but new.
Okay.
But then you've got stuff like the Shackalicious XL Gummies. Apparently that shot up to be the #2 brand in Sweets dollar growth.
Wow, Shaq still got it.
Seems like
I
it shows the power of those partnerships. And they're even doing like Jolly Rancher freeze-dried products, exploring new textures.
Freeze-dried candy. Interesting.
Yeah. And they're teasing this biggest ever Reese's launch. So clearly not resting on their laurels. They're diversifying.
That makes sense. And it's not just the sweet side, is it? What about salty snacks? I remember seeing Skinny Pop got a refresh. Wasn't Jennifer Aniston involved?
Exactly. Skinny Pop got a branding boost, and yeah, Jennifer Aniston was part of that push. And Dot's Homestyle Pretzels, that brand's been huge, is apparently getting into more households. So growth across the board there.
So they're investing across the whole snacking spectrum.
That's the picture they paint. They seem confident about hitting sales targets through more brand investment, better commercial capabilities, basically trying to grab more market share. And they keep mentioning these transformation programs for, long-term success.
Okay, that transformation piece sounds important. The report talks quite a bit about this Advancing Agility and Automation initiative. It was approved back in early 2024. This sounds big. What's the core idea behind this multi-year program? What are they trying to achieve?
Right. It's definitely a major strategic push. Think of it as a fundamental overhaul of their operational backbone. The goal is to get smarter and more efficient everywhere, improving supply chain, manufacturing spending, optimizing SG&A, that's selling, general, and admin costs. And they're leveraging new tech, automating processes, basically aiming for significant long-term savings and making the company more agile, more responsive.
So like a big tech upgrade for the whole system.
Pretty much. They've been rolling out a new ERP system that's enterprise resource planning. It went live for North America confectionery and some international parts in April 2024, and North America's salty snacks got it back in October 2023. They're building that digital foundation.
That kind of automation seems crucial right now, especially with costs being what they are. But, even a giant like this faces challenges. The report sounds confident about the long-term snacking opportunity, but mentions near-term challenges. What kind of external headwinds are they dealing with?
Yeah, that's a key tension. One of the biggest headaches is raw material costs. Cocoa is the headline grabber. Prices jumped, what was it, around 130% in 2024.
Whoa, 130%. That's huge.
It's staggering. And it's not just cocoa. Sugar, corn, dairy, peanuts, almonds. Lots of volatility. So they use financial tools, forward, contracts, futures, options to try and hedge against these price swings, kind of locking in prices in advance.
Like pre-buying your ingredients for the year.
Essentially, yeah, to manage that uncertainty. But it's still a massive pressure.
So for us, the consumers, does a 130% jump mean like smaller chocolate bars or just higher prices inevitably?
Well, companies usually try a mix of things. Efficiency savings internally, maybe some subtle changes to products or sizes, shrinkflation as people call it, and yes, strategic price increases. It's a balancing act.
Right.
And beyond raw materials, you've got potential supply chain disruptions,
Yeah.
anything from natural disasters to cyber threats or supplier issues. Plus, the whole macroeconomic picture is uncertain, right? Recession risk, changing consumer spending, geopolitics like the Russia-Ukraine conflict. It all adds costs and inflation pressure. And they also mention needing to sort of reset their international strategy because of shaky economic conditions in some emerging markets they were targeting. It's complex.
Definitely a lot to navigate.
Hmm.
So given all that, let's dig into the actual financials for 2024. What did the headline numbers look like? How did sales and profits turn out?
Okay, numbers time. Top line net sales for 2024 came in at $11,202.3 million. That was only up 0.3% from 2023. So basically flat sales.
Flat sales.
But, and this is the interesting part, profitability jumped quite a bit. Net income was up 19.3% to $2,221.2 million.
Wow, okay. Big jump there.
Yeah. And diluted earnings per share, EPS, grew even faster, up 20.5% to $10.92. Part of that boost came from them buying back their own shares.
Fewer shares makes each one worth more, earnings-wise.
Exactly. And operating profit was also strong, up 13.2% to $2,898.3 million. So flat sales, but much better profits.
That is a fascinating split. Flat sales, surging profits. How did the different parts of the business, the segments, contribute to that, especially with, sweets versus salty?
It really is almost a tale of two segments, especially the big ones. North America confectionery, the sweet stuff, actually saw sales dip slightly. It was driven by about a 4% drop in volume for their core U.S. candy brands. Basically, they sold fewer units.
Okay.
But they largely offset that with price increases, around 4% price realization. They also got a tiny bump from acquiring Sour Strips.
All right.
But even with the higher prices, the segment's income, its profits, still fell by 5.5%.
So higher prices didn't quite cover the lost volume on the profit side for candy. What about the salty snacks?
Totally different story there. North America salty snacks had a strong year. Net sales were up 3.9%, and that was mostly fueled by really good volume gains, up 6.6%. They sold a lot more pretzels and popcorn.
Nice.
Now, some of that was offset because they spent more on advertising, probably promoting Skinny Pop and Dots, like we mentioned.
Makes sense, investing in growth.
Right. And the payoff was huge for profits in that segment. Salty snacks segment income jumped by 26.0%.
26%. Wow.
Yeah, driven by that higher volume. Plus, they had favorable commodity costs for salty ingredients and lower supply chain costs. So salty snacks really picked up the slack for the whole company's profit growth.
That's crystal clear. Salty was the engine. What about the overall operating profit increase for the company? Were there other factors besides the segments, maybe things like corporate costs or those hedging activities you mentioned?
Definitely. Lower unallocated corporate expenses helped a bit. But a really significant factor was these unallocated mark-to-market gains on their commodity derivative.
The hedging stuff.
Exactly. They booked a $460.4 million gain on that in 2024. Compare that to a $58.9 million loss in 2023.
Huge swing. So their bets against rising commodity prices paid off big time.
It seems so. That really boosted the overall operating profit number. But on the other side, they did have much higher costs for business realignment, $117.5 million in 2024 versus just $3.4 million the year before.
Suggests they're spending money now on those transformation programs, hoping for future savings.
Precisely. Investing in that agility and automation initiative we talked about, it costs money up front.
Okay, that complex picture makes sense. Now, you mentioned cash flow earlier. The report talks about a change in how they measure free cash flow for executive pay. What's behind that shift?
Right. That's an interesting governance point tied to performance. For the performance cycle ending in 2024, their actual cumulative free cash flow was a bit under their target.
Oh.
Well, slightly under. So going forward, they're changing the metric for those performance stock units, PSUs, for executives. Instead of just looking at the total amount of free cash flow, they're shifting to 3-year free cash flow percentage of net sales.
Okay, so how much cash they generate relative to their sales.
Exactly. It puts more emphasis on capital efficiency. How effectively are they turning sales dollars into actual free cash, not just the raw cash number?
More focus on the quality of cash flow, not just quantity.
That seems to be the idea, driving accountability for how efficiently they deploy capital. And related to cash, their cash flow from operations actually dipped a bit in 2024 compared to 2023, partly due to some non-cash charges. And they also spent less on investing activities, fewer big capital projects or acquisitions last year.
Interesting. Okay, so beyond the operations and financials, how are they directly rewarding shareholders? What do the reports say about dividends and buybacks?
They definitely highlighted their commitment there. Total dividend payments went up quite a bit, $1,084.8 million in 2024 compared to $889.1 million in 2023.
Solid increase.
Yeah, and the dividend per share for common stock jumped 23.0% to 5.4408 cents. That's a pretty significant hike for shareholders.
And the buybacks helped the EPS number too, you said.
Correct. Buying back shares reduces the share count, which gives EPS that extra lift. So dividends and buybacks are key parts of their value return story.
Got it. So how does this all tie back to executive pay? You mentioned the new free cash flow metric. How else are they linking pay to performance?
Well, they emphasize that a substantial percentage of executive pay is at risk. For the CEO, it's 89%, and for the other top execs, it's 78%, meaning it depends on hitting performance targets.
Okay, so mostly variable pay.
Right. The annual bonus or incentive is based on net sales, adjusted EPS, and EBIT margin percentage. That's a core profitability measure. And there's that market share modifier, too, which can tweak the payout up or down by 10% based on how they do versus competitors.
They have the competitive angle.
Yeah. And then the long-term incentives, those PSUs, are tied to total shareholder return, how their stock does versus peers, adjusted EPS growth over several years, and now that new free cash flow percentage of sales metric.
So a mix of financial and market-based metrics. How did that play out recently?
Well, for the cycle ending in 2024, the PSU payout was actually 123.34% of the target.
Above target, even though free cash flow was slightly below.
Yeah, and their total shareholder return was only in the 42nd percentile, so below median compared to peers. It looks like strong adjusted EPS growth really drove that higher payout.
Interesting how the different metrics can balance out.
It shows how the specific targets and weightings matter. They also mention having a clawback policy, meaning they can take back incentive pay if it was based on financials that later had to be restated. Adds accountability.
Right. Okay, let's shift to something really unique about this company.
Right.
The ownership structure with the Hershey Trust Company. What does that mean in practice?
It's fundamental to understanding how the company operates and is governed. They have two classes of stock. Common stock, which most people buy, gets 1 vote per share. But there's also Class B common stock, which has 10 votes per share.
10 votes?
Yeah. And virtually all of that Class B stock is held by the Hershey Trust Company, acting as trustee for the Milton Hershey School. So doing the math, the trust controls about 79% of the total voting power.
79%. So the trust essentially controls the company.
That's the practical reality. It gives them enormous stability and shields them from hostile takeovers. Pennsylvania law also makes that difficult. But it means regular common stockholders have very limited voting influence compared to a typical public company.
Is there any benefit for common stockholders in that structure?
Well, one quirk is that the common stock actually receives 10% higher cash dividends per share than the Class B stock.
Oh, interesting. A little sweetener there.
A little sweetener, exactly. And the trust has made it clear they intend to keep that controlling stake.
So with that concentrated control, how does the board ensure proper oversight? And what's happening with leadership?
The board uses a committee structure for oversight. There's an audit committee for financials, compensation and human capital for pay, finance and risk management, governance, and an executive committee. Pretty standard setup, but crucial given the ownership structure. They oversee everything from financial integrity to ESG strategy. In terms of leadership, the current chairman, president, and CEO, Michelle Buck, is set to retire by mid-2026. And notably, the board has decided to split the chairman and CEO roles effective upon her retirement. That's a governance best practice aimed at, enhancing independence.
Separating chair and CEO.
Okay. And there's a special committee already searching for the next CEO. They also have things like a retirement age guideline of 72 for directors and a 13-year term limit for non-employee directors to ensure the board gets refreshed with new perspectives over time.
Seems like they're planning ahead for that transition.
They appear to be, yes.
Okay, we've covered a lot of innovation, challenges like cocoa costs, the split performance between sweets and salty, cash flow changes, and that unique governance. So as you reflect on this deep dive into a company that's behind so many treats, but also has this deep philanthropic history, consider this. You've got changing consumer tastes, a tough global economy, a leadership change coming up. How might this company's really embedded legacy, its responsible operations focus, that unique ownership, how might that shape its ability to not just grow, but also expand its shared goodness promise in the future?
That's the big question, isn't it? How does a company with such a specific long-term foundation navigate a world that's changing faster than ever, balancing profit, purpose, and navigating those headwinds? It'll be fascinating to watch.